Welcome to my quick start guide for trading commodities. Now, I've spent a huge chunk of my career in this space, in energies, metals, softs, grains, the whole lot, in various roles: front office, trading, risk management. So I'm hoping that I'm in a good place to be able to teach you the basics of commodity trading. So what we're going to look at, we're going to basically answer the how and why of trading commodities. Commodities is often an overlooked area of trading, but there's some great ways into the market that you might not have thought about before. So I'm going to show you those. Like I say, we're going to break down the market, show how it's constructed, because you need to know that if you're going to trade this sector. And I'm going to give you a few secret tools to help you along the way that I've used over my career, and we're going to finish off with 3 trading strategies for you to get your teeth into. So with all that, let's get on with it. So firstly, what is a commodity? I think we all know the answer to that. It's an underlying raw material, primary product like agricultural, mineral, such as coffee beans, gold, oil. There are so many of them, and they're a commodity because they can be bought and sold, and that's what this video is all about, that underlying commodity. And first of all, we need to dig into a bit of history to see how the market has evolved, because it'll all help your understanding of what we are doing today in that space. So starts way back with the Sumerians, and that is an area we now know as Iraq, and they were trading commodities from the known civilized world in those days, from the east, from like India and from Europe, from Africa, as a melting pot for creating their own market in commodities. And then Egyptians, the Romans, Greeks, they all developed their own markets in gold and silver, herbs, all sorts of different commodities. And really the commodities world evolved more in Europe from the 11th century onwards, where it was more regional market of exchange, and really didn't come into what we know today until really the Amsterdam Stock Exchange first started in the 1500s, buying and selling cheese, butter, and even tulips. But really it wasn't until the mid 1800s in the USA, Chicago set up agricultural exchanges like the CBOT to trade assets, and using eventually futures and options to do so. And it's really that part of America, Chicago, New York, Philadelphia, that corner of the world, that really saw the evolution of the commodities world as we know of it today. In terms of recent changes, there's been a lot, especially over the noughties. We've seen a massive growth in that commodity space. It's opened up to a far bigger global market. Markets like China have grown massively over the last 2 decades and been hoovering up, sucking up, playing with commodities and creating their own exchanges in the Middle East, you could say like Dubai and Europe. And for us, it's opened up the retail sector as well, with technology and changes there, which is all good stuff. And the participants, the flow of money has changed a lot more speculative rather than for the fundamental use of just using those commodities like foodstuffs, and as it was back in the older times. And it's, like I say, created an advantage to us, and it's often overlooked, like I mentioned before. But commodities are a great market. They are a bit more volatile than some, but with this extra participant behaviour, it's created more flow, more liquidity, and made it easier to trade. Who governs this market? Well, there's many global regulators out there, but we are more focused, well, I'm more focused on the US markets and the UK LME metals for reasons of liquidity, size of market, transparency, history, resources that are available. And important to know though how they operate. Now, the majority of the world, I would say, is US centric in the world of commodities. Most of it's priced in US dollars. That means that the US regulators are the most powerful, and the one you really need to know is the CFTC, Commodity Futures Trading Commission. Check out their website, cftc.gov. And you also have the NFA, the National Futures Association. As you'll find out, most of the commodities market is futures based. In the UK, it is the FCA, but remember there's markets all around Europe, Middle East, China, so check out their regulators. But they do have their own rule set and impact on the way these markets trade, so it's always good and useful to know who and what they are and what effect they have on our trading. So these are some key areas you're going to need to understand in the world of commodities to be able to trade them successfully. Some key knowledge words for you to work and develop on over time. Flow, that's the flow of money through the market. Liquidity, how easy is it to get in and out of these trades. Supply and demand, what's the push and pull factors of the buying and selling around the world. Seasonality, these markets, for example, grains, softs, very seasonal. Other fundamental analysis, there's a lot to commodities, and a lot of traders normally come from one of two aspects. Traditionally fundamental, but as markets evolve more, became more electronic. Technical analysis and behavioural quantitative analysis have also become very popular. But how are you going to trade these commodities? Well, you've got some weapons of choice depending on where you are in the world. You've got futures, options, forwards, CFD, spread betting, stocks and ETFs. We're going to have a quick look through those now. I do run other videos within the channel that you can follow up on if you want to learn more in detail around those, but we're going to, like I say, take a quick stab at those now. But just before moving on, just a quick one. Options, forwards, I'm not going to cover in here. Forwards are very specific, for example on the LME metals exchange in the UK. Options may be a bit more advanced than we need to get for this beginner's guide, so we're really going to focus on the futures. You may notice there a thumbnail, Futures Trading Beginner's Guide. I do run a very extensive video course there, totally free on the channel. Check it out if you want to learn more about futures. But the main advantage of trading futures is because of leverage, ability to go long and short, and the risk management functionality that allows you to do. To give you an idea of what sort of futures you can trade, very easily from the retail trading side of things. I'm in my broker, Tiger Brokers here. Go up to market, and we can then look over at the futures section and just have a look at some of those headings there. We got lots of precious metals. We got energy futures, agricultural metals. The choice is yours. So loads to play with and get involved with. And if you're from outside the States, then you might want to consider CFD spread betting. They have various advantages, tax advantages, but they're going to give you underlying access via synthetic type setup to trade commodities. It's going to give you the ability to go long and short as well as leverage. And you can see that little screenshot I put down there. It's a broker I use called Trade Nation, and that's just a snapshot of some of the metals that they offer to you, and in particular LME metals, base metals that are very hard for the retail trader normally to get their hands on. So today's world, very well funded by the brokers these days, giving you the opportunity to access these sort of markets. And what a lot of people forget is that you can actually use stocks to trade commodities. They're very highly correlated to the underlying if they're in that industry, and they can give you access to markets that you might not be able to enter into in regards to that underlying commodity. For example, Pilbara Minerals, Australian company, can't trade lithium direct, but you can get exposure through their mining activities to get you into the lithium, EV sort of play. And it's obvious if you look around, energy commodity stocks like ExxonMobil, ConocoPhillips, metal stocks like Rio Tinto and Barrick Gold. But there is one other way that you can get into the commodities world, and you don't maybe want to focus in directly on the stocks. There's something called ETFs, exchange traded funds, and think of them as a basket of stocks that replicate these type of commodities. Again, they're highly correlated to the actual commodity, these ETFs. Again, many advantages for trading them. Now, I just did a Google search, came across a website called ETF.com, and they published a list of at least 115 different commodity ETFs, ranging from lithium to any sort of metal, the agricultural side of things. It's pretty much covered there, and like I say, it's a bundle of stocks nestled together to give you exposure to that underlying commodity, and just to show you that they are highly correlated. On the left chart we have the gold ETF, and on the right chart we have the gold futures contract. Slightly different prices, but you can see the actual price movement there virtually the same. So you're buying in to, like I say, the underlying gold through stock exposure in a basket that is known as the ETF. So a whole host of ways that we can see to trade commodities. We've got futures, CFD, spread bets, stocks, ETFs, and as you get more experience, maybe have a look at options. Now let's really get into this trading commodities concept. Now, understanding the structure of the commodities market is essential for you to be successful in trading. I've mentioned that already. It's about pulling it to pieces and, like I say, really making it your own. And the most important concept that you're going to need to take away is that of futures. It is pretty much a futures market, the world of commodities. There's something called spot, which is the price. Now we're going to look a bit more into the terminology in just a bit, but really it's understanding the idea of futures, because it's going to not just allow you to come up with trading strategies, but also analytical tools, for example around the commitment of traders data. So that is what we are going to look at now, the structure of the market and how it works in commodities. Now, I've said this is a futures market. Why is that? Well, let's take a step back and have a think about it. Let's go back to that history section that we briefly went through, and you're wondering why we did. Well, if you go back to the 1800s in the US, and say you are a farmer of wheat or corn, and you've got to move it from Kansas all the way through to Chicago and the ports there to get it moved on. There's a lot of factors that come into play there. It's like the quality, quantity, the time, location of getting all of that stuff at the right place at the right time, because the buyer sitting in Chicago is expecting a certain, quality, and that led to these contracts called futures being put together. So there's a time element into getting the stuff out of the ground to getting it to the end consumer / user, and this is what the futures contract helps us with. It's a contract that states all these variables so both parties know exactly what they're getting, and the exchange in the middle sits between them, puts the buyers and sellers together and makes sure things all run smoothly. So really important to picture that it's a futures market. Yes, you can trade the spot price right now if you can exchange it quickly between parties, but the futures contract allows that, it did historically allow that time delay from, like I say, getting it out of the ground to the end user. Let's look at an example. WTI crude oil. It allows you to trade the spot price, the price right now, but it also allows you to buy and sell contracts of WTI based around its futures price, and this can create a whole string of futures contracts to trade going out many years into the future. And that sort of string is not really linear in its shape, and it's really created around the supply and demand, relative to that contract. And because of this wavy line, also known as the curve, it creates a unique shape, and that allows us to create strategies such as the spread strategy that we will look at towards the end of this video, where you can play one part of that curve off against another. And here's an example of that WTI snapshot from the broker Tiger Brokers. Again, you can see all the different contracts available. Note all the different dates, and it goes out quite a few years, and this is available to anyone. And you can see at each different point a different price. So if you can buy and sell those, like I said, there's a strategy to be had there. So this idea of the price curve might be very new to some, but it's again another important thing to know in the world of commodities trading. Remember, physical spot markets are markets you're trading the price of right now, and futures markets are markets you're trading the futures price of now. So that brings up some interesting points, some interesting terminology. The spot price can be lower or higher than the futures price today of the same asset, and that has, I hope you can see, important implications around supply and demand. Why is the price higher in the future than it is now? And if the price was higher, say, in the future today, you expect that market believes there must be some sort of supply and demand imbalance in the future, and that in itself is a very useful bit of information. And that brings up some terminology that we need to know about. Well, we've already talked about the curve. That's that series of price points joined together. And the interesting ones, the one called contango, well, that's if the spot market, the price today, is lower than the futures price today, and that market is said to be in contango. And vice versa, backwardations if the spot market today is higher than the futures market today, and that is known as backwardation. And what does that actually look like? It might help us cement the idea in our heads. So here's contango. Have a look where that spot price is now. It's down at 40, but look at that red line. That's the curve. Not normally that linear, as I said. It's just for the illustration here. Look how the futures price is higher at that near quarter and far quarter, and because that futures price is higher than the spot price, that shape of the curve is called contango. And here's the exact opposite, backwardation. Look at the futures curve, the red line, starting at 100, the spot price, it's falling back over time out into the future, and that is known as backwardation, spot price higher than the futures price. The downside of using stocks to trade commodities is that we can normally only go long the market for that stock, whereas commodities, if we're using futures or CFDs or spread bets, we can go long or short. So it's doubling up our chances of guessing that right direction, getting on the right trade. So for example, you might be bearish and you think soybeans are going to fall heavily due to a bumper crop. What do? Will you sell the futures contract now and buy it back later at a lower price. The same for the CFDs or the spread bets. So how does that actually work? Well, the exchange facilitates this long short mechanism, or in the case of CFDs and spread bets, it's through your broker. And for those very new to trading, just so we don't get confused, bullish means any market that is going up, and bearish means any market going down. And how does that link into going long and going short? It's quite simple. Going short is bearish, going long is bullish. And the examples here, you can see the long trade. We are buying now at 60 and selling at a later date for 100, making 40 profit. The short trade below that, we're selling now at 100 and we're buying back at a later date at 60. 100 minus 60, that's also a 40 profit. So we can get into the up or downside using these type of products. Like we said, the futures, CFD, spread bets, and that fits in very nicely with the commodities market as well. So what style of trading is right for commodities? It's a fundamental analysis, technical analysis, quantitative, behavioural. What works, what doesn't? Well, there is no right answer to that. It's horses for courses, what you want to use, what you've got your edge to the market in. Now, I use a blend of fundamental and technical. You can see in front of you there, that's a Renko chart for WTI crude oil. I would say more these days, as the way the market has evolved, I'm more maybe using technical analysis, automated, systematic trading, looking at using more behavioural quantitative techniques than maybe say 20 odd years ago when the market was more fundamental areas. But they're all very useful areas to learn and develop, and I would say even if you're going down the pure technical route, you will find yourself many strategies by understanding the fundamentals of these markets and then measuring them with technical analysis and executing around that sort of way of doing things. You will find that a very useful learning methodology in the world of commodities. If you're new to trading commodities though, I suppose technical analysis does cut through a lot of the legwork you're going to have to do in the fundamental world. It's going to save us time. I'm going to show you a few examples later. A lot of these assets are very specialist and we don't have the time or ability, the resource to get into those markets fundamentally. So we can use the charts to, like I said, save us a lot of time and energy and execute strategies purely just based around the technicals. You're going to also have to understand how the different assets sit together, and there's four main categories that you're going to need to know about. I'm going to break them down into energies, metals, softs and agricultural markets, and they all have their own personality and behaviour, and that some may suit you, some may not. Some are very illiquid, some are not, and it's finding the markets you want to trade, the ones you have knowledge in, experience, skills, whatever it is, focus in, and trade them. They're all going to be available. So let's just have a quick look at how that breakdown is of the markets are probably most available to you at the moment. As you can see from the chart here, we've got metals on the left broken into two areas, precious and base metals. Think of base as the industrial metals, copper, zinc, lead, tin, aluminium. Precious metals, gold, silver, platinum, palladium. And then we've got the energy sector. You've got crude oil, such as WTI, Brent over in Europe, UK. And then we've got refined products like gasoline, nat gas, heating oil. Then agricultural, and you've got that three subsections there. Now often I take softs off to the side of them, but under this I've bundled them all together. Meats, we got things like lean hogs, feeder cattle, live cattle. Softs, things like orange juice, coffee, sugar, cotton. And grains, corn, wheat, soybeans, you've got soybeans oil, meal, and rice. So a lot of markets for you to choose from. As we saw earlier on Tiger Brokers, they're all there waiting for you to trade, either to the up or downside. What are the biggest commodities traded at the moment? Well, crude oil, WTI, stands out way in front. Then we got nat gas, heating oil, sugar and RBOB gasoline. Sugar there also is a play for oil as well. It's a replacement sometimes. It's not just used for sweets, food stuffs. And then we've got main ones like gold, corn, wheat, soybeans, some foodstuffs there, and then copper, biggest industrial metal there is, goes into most infrastructure products and mostly enjoyed by China currently. As you can probably guess, a lot of the behaviour of commodities simply comes down to supply and demand. For example, grains are very good at this: corn, soybeans, wheat, driven by the supply side. There's fundamental reasons for this, as you will learn. Energy side driven more by demand, precious metals more by demand, and commodities really do have strong seasonal tendencies that you can take advantage of. What do I mean by seasonality? Well, seasonality is a characteristic of a time series in which the data experiences regular and predictable changes which reoccur every calendar year. And any predictable change or pattern in a time series that recurs or repeats over a 1 year period can be said to be seasonal, and seasonal cycles are contained within 1 calendar year. Now, lucky for you guys, I went through a lot of analysis here, over 20 years of data, to pull back a calendar of commodities by their seasonality for you, and I'll quickly run you through that. If you want to use it, maybe pause and screenshot and print it off. So the key to the seasonality table, you can see dark green strong bullish through to dark red strong bearish, and orange being neutral there. Cross reference by month, week you're in to ascertain what seasonality bias is to the commodity you're trading. And you could have a rule like, for example, if it's strong bullish, you're only looking to take long trades in that market. Just an example. And here is that calendar. You can see I've broken it down into different categories, and let's just pick on one for example. Well, let's go for cotton at the top there. You can see through January through to middle of March, very bullish. Then it's a week bearish all the way through to beginning of June. Then it becomes heavily bearish, then lightens up a bit until August, becomes very neutral, and then picks up again mid-November through, like you say, to the end of the year, and then continues through to March. So you can see the buying season there from mid-November all the way through to March. So that's how to use that as a seasonality table, and it does help, like I say, come up with strategies and ideas, and maybe a bit of risk management around what trades you should be in at any one time. So another example here, lean hogs normally plummets down in price towards the end of summer, simply because barbecue season's finishing. There's no more demand for the summer buying of lean hogs, pork, and we can see that within the charts. Those red lines there, those arrows going down, that's the sort of significant falls they have around that period. We're not pork farmers, we never will be, but that's where technical analysis can help us out and come up with strategies that we can see more visually and get involved with. And like I say, we can trade then those futures or CFD spread bets to take advantage of that fall in late summer of the price of lean hogs. Now I'm going to very quickly take you through some of those markets that you can trade in a bit more detail to give you an idea and to start you thinking about what you could be trading. I suggest there's a lot of detail on these pages, so maybe you want to stop the video, screenshot, whatever, and then read it in a bit more detail. But really it's to get you started and thinking. Also just pointing out how seasonal some of these markets are, which are the real strong ones in there. But like I said, just to give you an idea of the markets and their peculiarities and why you might want to consider them. Let's start with the energy sector, and this can be a confusing sector for some because there's loads and loads of sub products, and we're not concentrating on all of them, just some key ones, the ones with good liquidity and the sort of factors that we want to trade. Crude oil, WTI, which is the US one, and Brent, which is the UK European one, RBOB, gasoline, heating oil, and nat gas. Now, crude oil, WTI and Brent are a light crude, and the quality of these crude oils is very important. And from these qualities of crude oil, these crude oils are refined further to create sub-products like jet fuel, gasoline, diesel, and the ones that we look at, and the ones you'll probably be trading, WTI and Brent. WTI is the most traded commodity out there, and like I said, the WTI contract is the US benchmark. Brent is from the North Sea coast off the UK and serves as another price benchmark over this side of the pond. So some takeaway information for you. WTI is traded on the CME. It's light sweet, most popular grade. Like I've mentioned, most traded commodity on the planet. Very good for technical analysis, intraday trading, low spreads, good liquidity. Lots of information and resource out there. Follow the EIA, Energy Information Administration, for weekly stock updates. It's very political. OPEC Plus, US production cuts, wars, very common. It's demand driven. Price can be volatile, and very sometimes difficult to gauge, but can also trend nicely as well. And we can use spread betting, CFDs, futures, and as you gain more experience, options. Some websites for you to check out: eia.gov and cme.com. Now in the UK, Brent, that trades on an exchange called ICE, very similar to WTI. It's the European crude oil benchmark. There's some strategies you can trade WTI against Brent. It's a very common trade there. Demand driven, and again it's the same types of instruments that you can use, and website www.theice.com if you want to check it out further. Moving on to some of those refined products on the left there, RBOB gasoline. Again, it's on the CME NYMEX. 50% refined crude becomes gasoline, unleaded gas. Very, very seasonal. I'm giving this a 5-star rating for seasonality because of summer driving season over there in the States. Your refineries gear up for production for spring. Refinery problems can cause the market to spike, and hurricanes as well can impact, like the refinery, say in the Gulf Coast. Strongly correlated to crude oil. Similar instruments, spread betting, CFDs, futures, options, same websites as before. And then top right, heating oil, another refined product, same exchange, otherwise known as distillate number 2. 25% of refined crude becomes heating oil, and the US produces about 85% of its own heating oil. So some factors in there as well if you're thinking of strategy. Oil companies ramp up production before the winter season, obviously to meet demand. Jan, Feb weather crucial, so monitoring weather, there's another strategy. Can often see biggest price rises. Price typically follows crude, and again same instruments and websites to check out. Now nat gas, this is a US version. There are others around the world, UK, European, etc. And it's the one where the prices are really rising at the moment, causing us all to be paying huge bills. It's traded on the CME NYMEX, I said the US one, mostly methane, nat gas found alongside coal beds and other fossil fuel deposits, used in the US to heat homes and generate electricity. Very important in commercial industrial areas. US and Russia, probably 45% of world production transported in pipelines, as many of us are aware because of the recent Ukraine conflict, and we've heard about that all in the news. Produces almost 25% of US energy consumption. Winter is the heaviest demand, and it's a very weather dependent contract. Very volatile, can catch you out if you don't have the right trade management in place, and also reacts quickly to those storms in the Gulf of Mexico. Other price drivers: production, storage levels, and other substitutable fuels. Again, same instruments and websites to check out. So soft's a bit of a mix of commodities here. Going to quickly look at cocoa, cotton, sugar, orange juice, lumber and coffee. Many different types of classes, qualities, strands to these commodities, and often traded in different exchanges around the world. A lot of the ones we're looking at here are US focused, and these 6 very specific, and again you can master these. You can just trade one of these if you want to and make that your trading career. Very interesting to trade and also very good to trade. So let's check a few out. So let's start with cotton number 2 contract. This is traded on the ICE exchange. Listed the main futures months for you there. Check out the futures course to understand those. Used as obviously in clothing, furnishings. China, India, biggest producers. Also US pretty sizable as well, especially in the southern states, so weather can impact there. China are the biggest global consumers by a long way. Check out that weather. Freezing conditions, rainfall, hurricanes all can damage the crops and spike those prices. The USDA publish weekly cotton market reviews and can influence prices. Again, same instruments, this time a couple of different websites, usda.com and the ice.com, to check out if you want to learn more. So lumber, trees, traded on CME. Interesting one to follow this because it's a good proxy for the economy. For example, think about what it's used for. Home development, building, that sort of thing, paper, demand driven. So following the price of that, you can often see that the economy is either doing well or not. Big producers: Canada, US, Russia, Brazil. Heavily affected this contract by Canadian trade and that US Canadian FX rate. All the products, instruments that you can get your hands on, spread-bend, CFDs, futures, and the usual CME exchange where it's traded, to check out more data on it. New York cocoa, there is a London contract, but we're focusing on the US ones, traded on the ICE exchange. 70% of production comes from West Africa, so you can imagine that heavily influences the price. Disease, short shelf life, all impacting price. Demand based, harvest from October to January. Political problems can affect short-term price moves. Again, same traded instruments. Check out icco.org and the ice.com if you want to learn more about cocoa trading. FCOJ orange juice, frozen concentrated orange juice, trades on the ICE. Not too liquid and very volatile to the weather. Now this contract and the crop comes from Florida, so you can imagine hurricane season can bash that crop and make that price jump all over the place. Now this was the futures market, if you're into your trading films, that Eddie Murphy in the film Trading Places was trading, and like I say, weather massive driver of the prices. Brazil also a huge producer in this space. There's an old trading tip for this one: never be short orange juice going into January. The usual websites to check out, and quite a strong seasonality rating. Again, like so many of the commodities, coffee, Arabica that we're looking at here, many different types of coffee bean that you can trade, but this one under ICE exchange goes by the ticker KC. That's the one we're concentrating on. About 60% of global production, this one, and it's a certain quality of bean. The other bean is Robusta, and that's mostly produced in Vietnam. Now, largest producers of this one: Brazil, Colombia, Africa and Asia. USA, the world's largest importer. Companies like Kraft, Nestle, Procter & Gamble, Sara Lee purchase about 50% of the annual production of coffee. So interesting information there for strategies. Affected obviously by the weather, and there's another old trading tip: never be short coffee going into July. Seasonality not that strong. Often prices rise when demand is heavy and when the weather is cold. Same instruments and websites, ico.org, usda.com and theice.com to learn more. So last soft we're looking at, sugar number 11, trading on ice and sugarcane, 70% of world sugar production. In the US, this comes from Hawaii, Florida, Texas, Louisiana. 70% of worldwide production is consumed by the country that produced it. 80% import demand from developing countries. So clues for price activity: monitor Brazil closely, they're the largest producer. Ethanol is a big switch demand play there, which is good for prices. Producers have to decide how to alternate their crop between ethanol or the rest. Just have a look at crude oil as well. If crude oil up, that can sometimes support sugar futures. Now weather also key. Heavy rain is bad in Brazil, US, India, especially around harvest equals lost crop and the prices go up. Same instruments, USDA and ice.com to understand more about trading sugar. Now on to metals. Let's start in the base metals world. Think of these as industrial metals: copper, aluminium, zinc, lead, iron ore, all available to trade. I haven't broken down copper here, although it is one of the main base metals. It goes into most industrial tech type hardware projects, and it's not bad to trade intraday as well. Now it's on the LME or on the US exchange. It used to be called COMEX, bought by the CME, and you can choose either or. I'm going to just take a little look at some of those submetals that people forget about, and most stay with copper. Now they're not as liquid as copper, but still tradable. Aluminium, tin cans, that sort of thing, we're always using it. Biggest producers: China, Russia, Canada, India. China, again, like in copper, hoover up most of the annual consumption. Price drivers: China, construction, engineering, demand, etc. Check out lme.com for more information. And we looked at earlier spread betting through something like Trade Nation to get access to these markets. Lead, again, useful in battery production, medical applications, ammunition. Often occurs when mined with zinc. China, the biggest producer, then Australia and the USA, but China, biggest consumer as well. Prices really driven by China and Chinese demand, US dollar, and supply stock numbers. Check out lme.com again on their website. Then we have zinc. It's the fourth most commonly used metal, mined with other metals like lead and copper, used for galvanizing steel, batteries, into brass and bronze. Again, it's the same picture: China producing and consuming. Again, we can trade them spread betting, CFDs. Look at the lme.com for more info. And nickel as well goes into batteries, stainless steel, electronics. Very popular these days with the EV play. Philippines, Russia, Canada, Australia, big producers. Again, China are the main consumer. Also, I haven't mentioned other metals like iron ore, which is big in Australia. You can trade the futures there. They're on Tiger Brokers. And also lithium, very popular these days again with the EV growth market. Can't trade it direct, but find stocks like Pilbara in Australia and others around the world. I've got videos on it on the channel. My favourite lithium stocks to trade if you want to get exposure to that world. Moving swiftly on to precious metals. It's gold, silver, platinum, palladium. They're the four we're focusing on. If you hear the term PGM, that means platinum group of metals, which there are 6. Now gold, traded mostly on COMEX, which is now the CME, using jewellery, coins, electricity, conduction, proxy for money, all sorts of different things it gets involved with. China, India, traditionally biggest buyers. China, Australia, Russia, USA, the biggest producers. Often hear gold as a crisis play, a safe haven for when things turn nasty. Hard to judge at the moment because cryptocurrencies have come along and people went into that one, but maybe it will regain its strength there. Countries with most gold stored, USA, although countries like Russia, China heavily catching up. Supply and demand based, central bank policies also important. Very liquid, easy one to trade in and out of. Check out the CME.com for more information. Silver, I call gold's sort of moody sister, can throw a tantrum at any moment and is normally correlated to gold but will go off on a tangent. Used in all sorts of things, medicine, jewellery, electronics, again on the CME. More volatile than gold. Biggest producers Mexico, Peru, China. Price drivers gold, supply and demand, scrap, inflation. Again, check out the CME. And then on to platinum and palladium. Now, both really come from Russia and South Africa. South Africa probably edging it in terms of production. And platinum, biggest use, catalytic converters on cars. Now, it is switchable with the palladium, as so one gets a certain price, the other, switches in and out of. Again, palladium used on catalytic converters, dentistry, electronics. Look for supply and demand issues, mining out of South Africa and Russia for price activity. Check out CME.com if you want to learn more. Now, mates, here we're looking at lean hogs and cattle. Not going to hang around too long on these. They are very good for their seasonality rating. Note both 5 stars, but they are very illiquid and tricky to trade. So buyer beware there. Do your research on the website cme.com. Like I say, they could be worth adding into your armoury. Lean hogs I prefer out of the 2. So last section we're looking at is the grain sector. Very strong seasonal sector in commodities. A big tip there. Wheat, corn, soybeans offer a good liquidity and easier to trade than, say, meats, but can for some be slow, volatile and a bit sporadic, heavily influenced by weather conditions. So watch out for those weather reports, stock surplus, foreign competition, fundamentals. So a lot to think about when trading these, but can be traded technically as well. First up, soybeans. Now they've got 5-star seasonality rating, traded on CBOT CME. Very popular to trade in commodities as well. Very important crop, provides oil and protein in the US, heavily used in industrial farming, feed and around the world. It's got some derivatives that we'll look at in a minute. Now the main growers, the US pretty much, and top exporters, Argentina, US and Brazil, and guess what, the Chinese, the biggest importer. Like I say, very seasonal, normally bottoms in October. Farmers sell crop out of the fields, equals selling pressure, pressure subsides, and equals the post-harvest rally. Check out the seasonality table. Prices normally peak February and June time and then drop to those lows in October. The harvest November, December in the USA and May, June in Brazil. USDA crop reports can impact prices. Usual instruments, check out USDA and CME to learn more. Then we've got those 2 derivatives of soybeans I mentioned, oil and meal. Now oil, CME, CBOT, any one soybean seed contains about 18% oil. Once extracted, the oil is sold as vegetable oil, ends up in a wide variety of processed foods. Look out for the USDA crop reports. And moving on to the meal, used mainly as animal feed. 97% of soybean meal production globally is used as livestock feed. Price similar patterns to soybeans with a few slight differences. Again, USD crop reports, monthly releases, watch out for them. And again, same tradable instruments and websites, USDA.com and CME.com. Now our last 2 grains are the big hitters in this space, and we're going to start with corn, traded on CME CBOT, one of the most liquid commodities in the grain market, but can still be spiky and tricky to trade. Split these days between animal feed and food industrial uses, for example ethanol, biofuel, food, alcohol. Largest producers USA 35%, followed by China. Different types of corn available when they're planted at different times, but usually April to May, and harvest August to early November. Weakest prices usually prior to harvest between September and November. Supply excess to market as delivering. High supplies equal low prices. Then fall equals high levels of corn storage and need to sell to make way for new crop, and beginning to buy May, July futures in November, December, while prices at seasonal lows. Traders do not go short this period or sit on the sidelines. And December through May, prices can rise. Farmer grain sold and used domestically abroad. Traders, producers advised to initiate short positions at end of this time. Now, corn, soybeans fight over the same space, so battles over by spring after planting, to watch out those sort of numbers where the farmers are heading. Further price highs in summer if unfavourable weather can threaten the size of the crop. So major price influencers: weather, natural disasters, US dollar strength, biofuel demand, emerging market demand as a livestock feed. Price summary: high buying October, November, December, high selling Feb, March, April, May. News impact events, corn reports from our friends at the USDA. Check out those sites, and the usual tradable instruments. And finally, wheat, traded on the CME CBOT, largest produced grain on the planet. 47% of the world total production, just from 4 countries: China, India, Russia and the US. Got different contracts over in Europe, so we're looking at a particular type of wheat here. And in the US there's things like Durham, hard winter, hard red spring, soft red winter, hard white, soft white. Can be individually traded in the US, but we're interested in the hard red winter, which is also known as the Chicago wheat, and it goes by the symbol ticker W. Growing season depends on the type of wheat. 70 to 80% is hard red winter wheat, planted September through October, harvested mid to late August, and soft red planted September to October, harvested May through end of July. Its most popular futures contract to trade is the active front month. Now, very seasonal, and just to give you an idea of the sort of patterns and the transparency in there, you can almost get it down to days. Sell sort of January, buy Feb, sell May, buy July the winter wheat, harvest half over deck, and sell deck plus 1 day, by November 28th March. So just some ideas of how specific you can be there. So from the above, always look at the trading calendar, and that monthly crop report can impact stuff quite heavily. If seasonal bearish and monthly crop bullish, sometimes see a short artificial spike, price spike, and then lets the seasonals take over. Look for the USD crop reports. Can be a big market mover, and like I said, not bad seasonality wise. Check out USDA and CME.com for more info. Now you can see that it's a big futures driven market, heavily US based, especially for the contracts that we want to trade. Let's have a look at some of those secret analysis tools you may or may not be aware of that you can use using this sort of futures data. This is one of the reasons why we have to understand how futures fit into the commodities market. It's called the Commitment of Traders report. It is published by the CFTC, remember that regulator, every Friday afternoon in the US. And it is brilliant for us because if you can translate it, it's going to show us which way round the professionals and the groups of participants that actually use these futures markets for a living in commodities, the direction they are going with these contracts, either long or short. So wouldn't it be great if you knew which way round these guys were facing? And it's an underutilized tool, and like I said, I use it as a sentiment filter into my commodity trading. Found it very useful, and we're going to dissect it a bit here now so you can understand how you can use it. The great thing about this report is that it's totally free, and it measures the net long and short positions taken by speculative traders and commercial traders. And like I say, it's a great resource to gauge, how heavily these market players are positioned in the market. Now for me, I'm interested in two sectors. There are a lot more detail to this commitment of traders data that you can explore, but these are the buckets that I like to follow, and they are the commercials and the large speculators. I ignore the small speculators because they are almost always wrong, and that in itself is a strategy, a reverse maybe of that data there. But we want to know about the commercials and the large speculators. Why? Because both need to be right to keep their jobs, maintain their livelihoods and businesses. So to follow these guys, we're hopefully following the right direction because they need to be in that right direction. So who are the commercials? These are the producers, the end users of the commodity or futures market. These guys need to protect themselves from adverse, unexpected price movement by using futures to protect themselves. So it's like a risk management insurance tool for them futures. So if they are long, say corn, you're a corn farmer, they're going to go short a corn futures contract to offset that risk. So their point is anti-price direction. It's the inverse. So if we see big short movement in corn futures, then from the commercial sector there, then we know that the price is more likely on the way up. Now the large speculators, traders, these are hedge funds, CTAs, commodity pools. They're the pros, and it's their job to guess the right direction of the markets. If they don't, they get kicked out their job, they get the sack. So following them is a good tool because more often than not they are in the right. So if the price is going up, we would see a large movement in the futures market, whatever market that is, following that price for the large speculators, traders group. And getting hold of this information, where you're going to ask, how do I do this analysis? Well, if you're a programmer, then all this information is free from the CFTC in downloadable format, and you can turn it into your own tool. There are paid tools available, and in TradingView as well. If you use that charting package, you can do a few tweaks like I've done, and you can create your own analysis on this tool, which we'll look at in a minute. Let's visualize this first with an example though. We have, I think it's corn here, it doesn't really matter what market it is, but it's those lines below the price action. The blue line is the large speculators, the green is the commercials, and the red are those small speculators. Now notice the correlation to the price. The blue line always following the price, the green line doing the inverse. They're the two that we're following. So if we can follow them against the price, that is a good guide to where that market is going to move next. There's many different ways to use this data, changes in size of position, crossovers of large speculators and the commercials, extremes like overbought, oversold levels. You can turn it into an oscillator. Using the raw numbers, like I say, is difficult. So turning those large specs, commercials, small specs into an index from 0 to 100 makes the decision making a lot easier. So you could come up with some rules around, say greater than 90 is overbought, looking for a trend reversal, and less than 20 oversold, and looking for that price to change again. And you add in other indicators as well on top of that. You can use standard technical analysis like stochastics on that data. Then you've got yourself a powerful little tool. Now we've got another example here using corn again, but just taking it to the next level. You see the price at the top. I've just included the large speculators this time. You can see them nicely following, But below that, couple of technical analysis indicators. The first one is just a plain old stochastics on the price, but below that I've turned the commitment of traders data of those large specs into an oscillator, looking for those reversal points. So it's just an example of how you can start to put stuff together to create an effective trading strategy. And another example, this time using WTI crude oil. You can see the large commercials at the bottom and large speculators turned into an index, and again we are looking for the price action to verify our rules. We can see the large speculators moving up with the price there on the right hand side where those green arrows are, and we can see the large commercials starting to move down away from the price. So to me that is a bullish outlook at the moment there on that crude oil chart. So really easy way to give you a point of view on what's going on. I suppose the weakness of the commitment of traders data is that it comes out on a Friday, so it's weekly, so it's a bit longer term and a lot can happen in a week. So use this, I use this as a sentiment filter rather than getting in and out, unless you really want to put on much longer term trades. So now we've got all this information under our belt, let's now start thinking about turning our knowledge into trading strategies, and I've got 3 quick ones just to take you through, just as examples to get you started in the world of commodity trading. Like I just said there, these strategies are ideas. I don't suggest that you jump straight in and copy these. Do your own homework and build your own trading strategies around these concepts and ideas. Test them out thoroughly before going live. I work on derivatives of these and different setups, but this is like the core fundamentals that you can take with you, like I say, to get you really started trading in commodities. And let's take a look at the first of 3 ideas I've got for you. Now, first strategy, very traditional in the world of commodities futures trading. It's called spread trading. Don't get that mixed up with spread betting. It's very different. It's about putting the different parts of that futures curve together. You might be buying the front part, selling the back, vice versa, putting a whole mix together. But like I say, it's a very traditional effective strategy. And if you've got a broker like Tiger Brokers, where you've got that long string of futures expiry dates around a contract, then it's a very doable, workable strategy. So let's have a look at an example. Hypothetical. You're an oil trader, you think the price of oil now is going to go down due to oversupply, but you also believe that due to large scale production cuts in the future, price is going to go up heavily. So futures curve is in backwardation. What do you do? Well, first of all, you're going to find that structure, that curve structure for the product you're trading, and in this example it's WTI crude oil. Here we are in Tiger Brokers. You can see all those months going forwards and all the different prices. Remember, this is just a hypothetical made up example, but that's to show you where you would be heading first to find the contracts to choose. Now, a lot of people will do like a front month spread type trade, maybe the spot price or close to, and then a sort of more closer futures contract. Some do the front and the front and the far, but I suppose it's all down to studying and analysing that curve structure and its historical nature. How does it behave? If you know that, then you can put these type of trades together. Now, if you take my futures course like I mentioned earlier, then you'll learn about the amount of money you have to put on your account to get futures trading working for you, and it's all down to the margin. And if you get into a futures contract and you think it's too expensive, often the major contract has micro and mini versions that are a lot more affordable. You can see here this major crude oil WTI one, you're going to need at least $11,500 to just be able to get into this trade for one lot. So you've got to factor that in when you're putting positions together, how much margin you're going to need on tap to make this trade work. But if you're in CFDs and spread betting, probably more affordable, but it's probably harder to get the curve together, because often those brokers don't offer those points, whereas a proper futures broker will do. But there's plenty of options out there. So back to the example, this is how we'd put that trade together. At the same time, we'd sell the front month now futures contract, and we'd buy the futures contract, and we're going to go for about a year out. So this is what we did. We sold that front one at 89.53, that's November 2022 futures, and we bought the November 23 one at 76.97. Now in 2 weeks time, idea starts to work, and the prices are now 84.53 for the short trade and 86.97 for the longer term 23 trade. So what's that done in terms of profit and loss? So if we then decided to close both parts of the trade, we'd have made 5,000 profit going short on that November 22 contract, and we'd have made 10,000 on buying the November 23 contract, one of each, and in total that's a 15k very nice profit. That is a very obvious example. Doesn't always work like that. Sometimes you take a loss on one because you think the other's going to move more than the other. So it's down to the strategy design. That's why it takes a bit of research and knowledge of how that market behaves to put these trades together. But you can see there's good upside, and because you're knowing and understanding the curve, it's also helpful for risk management sort of purposes as well when you're putting together this type of trade. Now strategy 2 is a bit more of a hybrid, and it's going to give you different options. As you can see there, it's a blend, 60% technical analysis, 10% behavioural psychology and 30% fundamental analysis, but we can focus in on different parts if we want. So let's get into the meat of this idea. So the main idea, core concept behind this strategy is that commodities like to move in repetitive patterns due to supply and demand, human behaviour or other fundamental events, and these patterns are tradable. They don't exactly repeat themselves, but they're in that same sort of zone, and we can use technical analysis, commitment of traders data, seasonality to put that together to give us a better chance of being right. So we've got 3 parts to the strategy. First of all, we've got to map the underlying seasonal patterns, and we're going to then look at the commitment of traders data to find out which way the markets are pointing, and then we're going to use technical analysis to provide another neutral overlay and help us get in and out of the trade. Now this strategy gives you options. It can be traded many different ways, and I've sort of laid them out here in this block diagram. At the top there you can TA, technical analysis. You can just trade it purely like that, or you can add in those other factors: seasonality, commitment of traders, technical analysis, then trade. Or you might just do seasonality and technical analysis, or you might do commitment of traders and technical analysis. Down to you and what you want to do. All work. Like I say, test them out, find the markets you want to trade and apply these different methods. So what are the costs tools to this strategy? Well, charts, end of day, I'll mention that in a minute. It's probably 4-hour end of day weekly type charts. So TradingView, perfectly fine, or your charting package. Commitment of traders, again, you could get it from TradingView, develop your own out of the CFTC website, or go to someone like Copbase, which is paid for, pretty cheap. Tested it, it's not bad. Something for you to think about there. And also seasonal analysis, you're going to need that, but fortunately for you, I've done all the hard work there and it's free and available. Just print it off, screenshot it from here. Remember what we said, we're going to run the seasonality filter first, then the commitment of traders, and then we are going to produce short lists, narrow that down further, and then apply technical analysis over that with the different types of setups. I mentioned 4 there. That's because I use Kagi, Line Break, Heikin-Ashi and Renko in my world, but it's up to you. Works in any sort of chart type. So then it's down to you what you want to do. It's that combination that we looked at: seasonality, COT, TA, seasonality, TA, COT, TA. Totally up to you, but make it consistent in your approach. Make it part of that trading plan. So let's have a look at that first filter again. It's the seasonality one. Don't forget the colour coding and what that means. So let's have a quick look at some ideas. At the time of putting this video together, it's mid-November, so I'm going to take that as the starting point. If I start from the top, looks like cotton, cocoa, all starting to turn bullish. Sugar's already bullish. Not a lot there going on in meats. What else have we got? Well, in grains, it's a mixed bag. We got soybeans are bullish, wheat bearish, oats looks like it's just about to take off. And then into metals, copper, gold, quite bullish this time of year. And then energy markets, crude oil, heating oil, traditionally weak, nat gas always picking up due to the weather conditions, and RBOB as well, gasoline also bearish. So just from that you can start to create a shortlist. We've narrowed the commodity list down further, and then you would take it through to the commitment of traders data maybe as your next filter. Now looking at that COT filter, like I said, you can go many ways, build your own, use TradingView, use someone like COT-based, just Google it on the web and find providers. Here's COT-based, you can see it provides a short list of top buy signals, sell signals, the lot, so you can marry that up to the seasonality maybe as a possible strategy, or just use it on its own and combine with technical analysis. So I think for this sort of strategy, 4-hour daily weekly chart, to me is good. You've got to be a bit more patient sometimes with commodities. Yes, you can intraday scalp, there's some markets, but this strategy requires a bit more patience. For daily charts, I'd use more liquid commodities. Weekly charts less liquid. Some commodities don't trade a lot, things like lean hogs, feeder cattle, live cattle, so use the weekly charts there. The rest, use a daily chart and maybe the weekly charts for a longer term trend filter. When do you want to be doing the analysis for these filters? Well, any time that fits in with your trading plan. Early evenings, weekends, depends on how involved you want to be. I do it daily. Probably takes me 20-30 minutes to come up with the final solution for what I'm going to be trading. So then we get into trading it, and the setups that I use. Check out technical analysis playlist or the ultimate trading course playlist for examples around Heikin-Ashi, Kagi, Renko, line break, and many other types of trading set up for you to execute on. So what about managing the trade? Well, you're going to have to set appropriate stop loss levels. Remember, commodities market's more volatile than most, so you're going to have to factor in that volatility. So average true range, HV stand for historical volatility analysis, essential so you don't get stopped out quickly. These are longer term trades, you're going to be sitting them in them longer, so maybe start with 2, 3, 4 ATR and work from there. When I say work from there, add in other variables like Fibonacci, trend lines, other indicator tools to refine that number in to get you to the ultimate sort of stop loss area. But make sure you are consistent. If you're going to be trailing stops, make that a hard set of rules. Same with your price objectives. You need the strategy to work longer. You're going to have to be able to measure it successfully to see whether it works. You can't be trying things, tinkering all the time, because you're never going to know whether you're onto a winner or not. So I'm not going to go into too much detail on this last strategy in this space, and I'll explain why in a minute. But if you're going to day trade commodities, my big tip here, use liquid markets with low costs. Low costs, what do I mean? Check the spreads in your broker platform. No point trading them if your profit's going to be wiped away by those costs. And there's only a few markets that I think are really good for day trading: gold, WTI, silver, copper, sugar, wheat, soybeans. They're ones I use. And my reason for not going into the setups in so much detail here is because they're covered elsewhere on my channel, and in particular these are going to be technical analysis based setups, and I have a great playlist there, and if you're watching this video, you're probably new to commodities trading, maybe new to trading full stop, and I've got a playlist called the Ultimate Free Trading Course. There's nearly 100 videos in there, I think, and it's going to take you from zero to hero in the world of trading and take you through all you need to know. And inside that, there's a lot of day trading setups, the technical analysis you're going to need to know. You've got the fundamental basics in place now around commodities trading. It's then refining it into your trading plan, in a lot more detail than we need to go into here. So I suggest going through that playlist, finding the videos you want to watch, and then hone in on them. If you're new to trading, go through the whole lot. Nothing to lose there. It's going to give you a lot of idea and thought for taking your trading a lot further. So how do you get into that playlist? I'll show you now. It's really quite simple to find. Just go to the channel homepage, and as you can see down there on the left, Ultimate Free Trading Course. If we view that full playlist, you can see all the different courses and modules, videos that you might want to take and study. Day trading in commodities, also very effective, very profitable if you do it right. So I suggest you set the time aside to learn first before getting stuck in. But like I said, that's the playlist, and just for you, I've included the link here.